Good afternoon, everyone, and welcome to COL Conversations, our webinar series that brings you closer to the leaders of different businesses and known experts in markets and investing. I'm Marvin Fausto, President of COL Investment Management and Officer in charge of COL Fund Source, the country's first fund supermarket. The world just went through and is still going through an unprecedented pandemic. For the past 2 years, nag-anniversary na tayo. And now, we're even faced with these geopolitical events in Russia and Ukraine that is affecting our daily lives due to the effects that it has on commodities like oil. We may not have seen gasoline prices this high. So fears of higher inflation and a downgrade in economic growth is affecting markets, not just here, but around the world. Global markets represented by the MSCI All-Country World Index dropped to a low of 12% year-to-date already this March, as of March 14. But it has recovered, but it's still down. No? While most of us are invested in the local market, I ask myself, is now a good time to invest in the global markets now that it has gone down? Diba? Sabi nga nila, when there's blood on the streets, sabi ni Warren Buffett, diba? One of the greatest investors. If there's blood in the streets, it's a good time to buy. So, literally, there are blood in the streets in Ukraine, so might consider that as well. So, in this conversation, we have invited Sun Life Philippines, one of the largest investment management companies in the Philippines, where they will share their global outlook and answer the following. How can the war affect the global markets, and what does this mean for investors? What are the investment opportunities in the current market conditions? And what should investors consider in managing their portfolios? But before that, before we proceed, here are just a few reminders. This conversation is not an endorsement or a recommendation to invest. This is being conducted to have a better understanding of available investment opportunities and help the audience with a more informed investment decision. Okay, without further ado, allow me to introduce our speakers for this afternoon. Sun Life, as you know, is one of the leading insurance companies in the country and has been around for over 127 years. They manage over 180 billion in assets under management. Here they are represented by Mr. Mikko Vergara, who is the head of global funds for Sun Life Investment Management and Trust Corporation. Mikko is responsible for the formulation of investment strategy and portfolio construction for all Sun Life Philippines offshore fund-to-fund and feeder fund products. During his 14-year time in the investments industry, he has held various roles in portfolio management, equity research, and trading. Mikko will also be joined by Cruz, who is currently the manager of banks and alternative distribution channel of Sun Life Asset Management. She and her team oversees the distribution of Sun Life funds through banks and broker partners, including COL. COL, as you know, distributes more than 30 funds, and in our COL Fund Source platform, and Sun Life is one of the largest funds that we distribute as well. So, without further ado, again, ladies and gentlemen, let us all welcome Sun Life for their presentation. Mikko?
Thank you, Marvin, for the kind words. Good afternoon, everyone. So again, I'm Mikko Vergara. I head the Global Funds Desk for Sun Life Investment Management and Trust Company. So today we'll be going through a few topics. I think offshore investments is something which has really come to the forefront, I'd say in the last maybe 3-4 years for Philippine investors. I'd like to talk about some of the behaviors, some of the reasons why current clients and future clients should look at adding these investments to their existing portfolios. After that, maybe we'll segue towards current events and how some of the developments can affect global assets moving forward. So next slide, please. So before we think about where we are now, it's important we think about what happened leading up to today. So I have a chart in front of you. There are two sets of bars. The yellow ones are actually for 2021. The blue bars refer to the 5-year annualized returns of these markets. So on the leftmost bar, you have global equities. So like Marvin talked about it a while ago, we call it MSCI ACWI, or All Country World Index. So it's the global equivalent of the Philippine Composite Index. So it encapsulates all of the major listed companies offshore, from the US to Europe to Japan, even parts of the PCOM are part of it. So what I want to show you is there were key trends which were broken in 2021. First of all, over the past 5 years, growth, I'm sure you've heard about it now, growth stocks, technology, these things have really done well over the past 5 years. So in the middle of the chart, you can see growth as a style. It did about 21% annualized over the past 5 years. Its sister or its equivalent partner index would be value. So now, when you talk about growth and value, growth refers to companies who generate very, very high levels of earnings, and in a future state, they're targeting very, very high sales growth. Value captures more of the mature companies who tend to pay out more dividends, whose growth in terms of earnings is not as high, but tend to be more stable. So again, in 2021, value overtook growth for the first time in a long time. It'll take some time for value to recoup or recover what it's lagged versus growth over the past 5 years. But I think given what value has shown us, it may be the start of a new investment cycle. So growth and value, they're always compared. Value tends to have, again, high dividends. They tend to have stable earnings. And in times where markets are unsure about how things will pan out, tendency for investors is to prefer stability or certainty. And I think that's why value has done well in 2021. The other thing which I want to highlight is in 2021, actively managed funds in the US actually lagged the broader S&P index. So for example, if ever you buy funds with active managers in the Philippines, your intent is for those funds to outperform over long periods, right? Over the longer term. But again, this is one key inflection point we've seen, that where the active managers had a hard time keeping up with the beta or the broad S&P index in 2021. So can we go to the next slide, please? So I guess for my first point, why should we think about investing offshore? From Sun Life's point of view, I talk about it from our AUM composition. I would say 90% of Sun Life managed AUM is really in pesos. That connects with our primary target market, right? Our primary clients are Filipinos, the bulk of whom generate income in the Philippines. So you would expect their disposable cash to be pesos as well. So from our point of view, it's nice to think about that other 10% because it may be something you need to add to your portfolio to diversify. But why this hesitation? Why hasn't it been on everybody's radar screens from day one? I would highlight behavior and bias. So for example, you are a retail investor. We may not be able to access the same types of products offered to private banking clients or high net worth clients. Sometimes, even if you are a private banking client, you need to hit qualified buyer status or a minimum of about 20 million pesos to attain or to be able to invest in a more comprehensive list of products. So I think in the current market, that's not the case anymore. Firms such as COL, Sun Life, we've helped liberalize, offshore investments for local investors. The other thing is, what do clients know about offshore markets? I think the first thing your advisors will tell you, invest into something you understand, right? But again, if you talk about other countries, do we know how they run their economies? Do we know who the biggest shareholders are or the biggest companies are? So for us talking about the Philippines, we know the Ayalas, we know the C Group, it's very intuitive to us. So I guess information is the second point within this slide. If we don't know who we will be investing with, that creates apprehensions or hesitations about pulling the trigger. What about regulations or policy? Sometimes it's easier for other countries to convert currencies and actually for investors to buy offshore. So in our case, we need to have maybe without a private bank, we'd have to set up a trading account with a foreign broker to buy US equities. But again, with the developments we've seen in the past couple of years, where foreign funds partner with local companies and local companies partner with existing investors to actually distribute these existing products, it's a good thing in that you don't need massive AUM to participate, and you have someone to talk you through the process of what you're buying. So on this chart, I'm showing you several countries. So the more you're on the right side, Japan, you see a 67%. The bigger the number, the more likely citizens there are more invested in their home market. On the opposite side, UK investors tend to be more aware or more exposed to offshore investments. So it's not necessarily a Filipino thing. It's not necessarily an Asian thing. It depends on the level of information, on the level of access each market has for their investors. So can we go to the next slide, please, Lucy? Okay, so what's my second point? Why should we invest offshore? There's really so many other markets to look at. PComp has about 30 stocks. Our market cap, we're not in the top 20 biggest stock exchanges globally. So on the left-hand side of this slide, I'm showing you 20 of the largest by market cap exchanges. So you have the New York Stock Exchange at the top. In the middle, you see some Asian markets. At the bottom, you have Taiwan, Australia, Tehran, Johannesburg. So again, it's very diverse, but I think the messaging is, if we look outside our home market, there are many other options in terms of single security names, sectors, or even different types of exposure we can take on. And on the right-hand side, I want to show you stock markets are really driven by the economy, right? So if ever your economy is bigger, more than likely you have more companies supporting that economy. So it follows that the bigger the economy, the bigger the stock market. So you can see US is top in terms of GDP. US is also top in terms of market cap. So again, just something to think about. There's other places we can invest in outside of the current market. Next slide, please, Cersei. So number 3, correlations. Whenever you take or buy investments, do you think about how they all move together? So on this chart, I'm showing you that some countries move together and some don't. So on the right-hand side, you see a 1. The closer a market here is to 1, the closer they move with the US actually. On the opposite side, if the number is closer to 0, your market is uncorrelated. So therefore, if the US falls, Japan, Taiwan won't move down to the same degree as UK or France, based on historical correlations. So why is this important? If markets move up, we're all happy. But if markets are moving down, we don't want to be correlated too much to markets who are moving down. So sometimes it's beneficial to have a low correlation, or sometimes even a negative correlation. So again, if we buy Philippines, I would say we're sort of closer to Taiwan in this scope. So we are relatively less correlated than other European countries to the S&P. But overall, having many countries within your portfolio allows your portfolio to survive different market cycles. Because hopefully, in a rotation cycle, not all your positions move down in the same direction. Maybe some will offset some losses, and some will actually provide upside or alpha to recover, to make up for other markets. So next slide, please. So again, another point from the correlation, it's volatility, right? So again, we're all happy when markets are moving up. But what about the current scenario where global equities have started on weak footing? Or like Marvin talked about a while ago, I think we touched about 13-14% down for the ACWI year to date. So do we like volatility in the portfolios? Yes and no, right? Yes, if it gives us good entry levels, but no, if we're the type to watch our portfolio day in and day out. So I'm just showing you on this chart. At the top, ACWI Japan has a volatility of about 21.5%. So that means it could go up by 21 or down by 21% as well. If you look down, MSCI ACWI is actually lower, no? At about 12.5. It's almost half of MSCI of ACWI Japan. So another benefit of having different countries is not all parts of your portfolio move around to the same degree. You know, in good times, it's beneficial. You may be giving up some upside, but in bad times, it gives you some protection that not all of your portfolios will correct to the same degree. Maybe some will correct, but maybe some less so. Next slide, please. So again, why offshore? In the local market, we have 30 index names. On the all share index, I think we have about 250 or sub 300. So what if we're not happy with our country's earnings forecast? Are we stuck with that? What if we can buy another country whose GDP seems to be above trend versus the Philippines, who's a country whose earnings seems to be better than ours on a sector by sector basis? So I think that's one other benefit, no, by looking offshore. We can buy markets who have better prospects in the near term and in the long term. Next slide, please. So I guess talking about growth potential, right? At the end of the day, what matters to us investors is earnings, right? It's a little bit moot if growth is moving up, but companies cannot generate margins or profit at the end of the day. So ultimately, if we look offshore, we'd like to invest in markets who have outsized earnings potential now versus their own history and versus comparable markets. So on this chart, I'm showing you some of the popular indices. So if you look at it, no, for 2022, this was done about March 8th, no, so a little bit after Ukraine started. So if you look at the earnings forecast for the Philippines, from Bloomberg consensus numbers, it's about 29%. So that's very, very good. What about other markets? So we can't keep all of our assets within Philippines, right? So our point is, if we spread out all our assets, what other markets have very, very high earnings? So you see UK looks to deliver about 30% earnings growth, no? For the same year. So think about it. We can compare earnings at face value, but we need to compare it also versus history. So is 30% very, very good in terms of UK's history? It is. What about for the Philippines? Is 28% good versus its history? I would say 30% earnings in a developed market is a bit more attractive because developed markets tend to be slower moving. No? So if we're just talking about magnitude of difference above history, UK is quite interesting for me. You know? But then again, it's just that's what we're trying to communicate is we don't have to be stuck to one market. There's many, many other markets we can consider looking at. No? Next slide, please. So valuations. This one comes up all the time. So leading up to 2021, valuations was the key reason people were worried about equities, especially with the Fed looking to raise rates. So are we happy with current Philippine valuations of about 16.5 times? Can this go lower? So if you look at across the board, on the left-hand side, Taiwan's trading at 12.4 times. You see Japan Topics at 12.3 times. So there's other options we can look at in terms of allocating our exposures. No? So again, you compare PE versus neighbors, but you also need to compare PE versus its own histories. No? So again, something to consider outside of earnings. Make sure the valuations are appropriate for what you're going to buy. Next slide, please. So again, now we're moving to catalysts. Okay, so we've talked about broadly 5 points why we should think about looking at other markets, no, outside the Philippines. But let's talk about catalysts. This is really what's shaping asset prices, no, in 2022. So moving into 2021, everybody knew the Fed wanted to raise rates. They've been telegraphing it consistently, no. Why is this the case? From COVID, you recall the Federal Reserve stepped in, the government of the US stepped in, no? They added stimulus checks. They were buying bonds to make sure rates would move down to support the economy. So what has happened? Growth has really rebounded. corporate earnings have moved up as well. So the thing is the risk is overheating may happen. That's why the Fed has to raise rates occasionally. So in this case, no, with inflation moving up and the Fed wanting to cap off overheating in the economy, it creates a risk on asset prices because valuations need to be adjusted for higher risk-free rates. So if you look on the right-hand side of the slide, I have another chart there. I'm showing you the real rate of 10-year treasuries minus the headline CPI. So you can see at the left-hand side, it was positive, no? In early 2019, it was about 1.2 basis points. So if you go to the right-hand side of the chart, it's actually in negative numbers already, right? So that's what we talk about when we say negative real rates. So for example, it's harder for consumers to invest their money if they're not realizing any interest anymore on their investments. So that's one reason also why there's pressure for people to go into riskier assets. So why equities were becoming more popular, even for people who didn't normally buy equities. So that's one constraint, no? When the Fed pumps the brakes, asset prices tend to revalue down because risk-free rates are moving up. So can we maybe one slide further, Lercy? Okay. So on the aside from the Fed, no, what's been talked about a lot in the news? It's really been inflation, particularly energy. With Ukraine happening, we've seen energy prices move up. But I think what I want to highlight to the group is if you look at this chart now, so this is Brent, this is global oil price. Brent has actually moved up pre-Ukraine invasion. So you see that bottom around the 2020 mark, no? So that was when the economy reopened and people started going out, people started getting vaccines, the Fed started stimulus. So markets reopened, economies restarted. So demand for Brent or energy went up again. So my point is, even if Brent did move up following the Ukraine tensions, Brent had already rallied 300% since 2020, no, about the second quarter. So let's put it into context. Oil has moved up about 40% at the peak, no, of the Ukraine invasion. But before that, it actually rallied over 300% also. So in context, it's a continuation, or rather an overshoot of the rally we saw following the economic reopening. Next slide, please, Lercy. Okay, so another catalyst, no? So how do military tensions or problems pan out? So on this slide, I'm showing you S&P returns. But offhand, I want to bring your attention to the lowest row on the 1 month later column. So if you look at it, markets tend to rally, no? Markets tend to become positive 50% of the time over the 1 month, the 3 month, 6 month, and 12-month periods after a military episode, no? On average, returns range from 1.3 to about 8.6%. I think if you look at MSCI ACWI returns as of yesterday, coming from Feb 23, before the invasion happened, no? ACWI is actually up 1.4%. So it actually, it's true to form or true to stats based on this table. So next slide, please. And what's the other thing? COVID is still with us. One of my main points later at the end, no? There's no return to normal. We have to live with this. We have vaccines. Our spending will adjust. Our living conditions will adjust because of it. But offhand, historically, markets have tended to rebound or recover, no? Similarly, when it comes to pandemic weakness. So whether it's 6 months or 12 months, for the most part, markets recover and move past that specific pandemic event. Next slide, please. So this is a table patterned after a FactSet table. So what we're trying to show you here is cumulative returns, okay? So on the second column on the right, we have total returns for the MSCI ACWI, again, the global equity benchmark. On the right-hand side, we have annualized returns. So these are periods from 99 up to 2021. So on average, no, discounting economic problems, military problems, or health scares, markets have tended to move up in spite of all these problems. Growth has tended to recover in spite of all these problems. So I guess that's how we want to frame it to you investors. We're investing for the long term. So, prices tend to recover. Prices adjust to their added risks within the market, no? And they move past it, as shown by this chart, no? Moving back since 1999. So next slide, please. So summary, again, no return to normal. It's really difficult to see markets going back fully to how it was pre-COVID. Our children will have to go to school at some point. We have to go back to the office at some point. But how have we adjusted? No, I've heard in our office they're looking to add more filters, these UV type filters. I think people will always have masks. People will carry more alcohol on them than normal. You will plan your routes. You won't take unnecessary risks. But life will go on. And it's the same thing with investments. Companies are planning to expand their businesses in spite of these challenges. Companies are planning how to, maintain earnings levels and stay profitable for their investors. For the second point, central banks will keep making sure growth continues. I think with the Fed, the key thing is from focusing totally on the labor market, there was some risk inflation was getting away from them. So they dropped the use of transitory, from their statements. So I think they will be more moderate in terms of the pricing, or rather the adjustments of rates, no? So previously markets thought the Fed would raise rates by 50 basis points this March. They've actually just done 25 basis points. So again, they're watching the data, they're keeping an eye out on current developments, no, to adjust their own policy routine. And then again, safe haven assets like the dollar and US Treasuries always have value in the current portfolio. That's because there are no alternatives yet. So if people are afraid of US equities tanking, automatically they buy the safest government bond. And what is the most liquid version of that? That would be Treasuries. Filipino investors who don't buy US equities have heard of US Treasuries, and they probably have invested into it in one way or another. And then my last point is, again, as shown in the tables a while ago, equity markets tend to recover from military, pandemic, or other economic, hurdles, no? They tend to move past it and recover past it. It just depends how soon or how deep the correction was initially.